All right, welcome in our weekly market wrap up. Today we're gonna talk about the latest macroeconomic events, the latest market developments, and what's been happening over the last couple of days. So if you enjoy these market talks, please make sure to spread the word, give this recording share, a comment, and make sure you're subscribed to the channel so never miss out on future updates like this. Now let's go ahead and jump into it. So on Tuesday, we had the CPI coming out at the lowest levels it has been in since 2020, since 2021, essentially. We've seen 2.3% for April, which marks the lowest level since February of 2021. So this is a clear indication on where monetary policies are headed next. I believe all of this will lead up to the end of quantitative tightening. And this is something that we have to pay attention to. This is something I've covered many times before in my past conferences and past videos, that all of this, the current macroeconomic environment, is gradually leading up to the end of quantitative tightening and to the Fed finally stepping away from their quantitative tightening measures. But this week we had some really interesting developments in the bond market, which we'll cover in just a few minutes. So even though the CPI came in at the lowest level since 2021, then we later on had the PPI, which came in at minus 0.5%, which is also at the lowest level since 2020. So this time it goes, so this is a clear deflationary indication. The producer price index, for those that do not know, front runs the CPI, as it generally tends to have this leading effect because it signals the inflation rate of producers, essentially. So it came in at minus 0.5%. We also had then the PCE coming in at the lowest levels since 2020 at exactly 0%. So we had the CPI coming in at the lowest level since 2021. We had the PPI coming in at minus 0.5%. We had the PCE core prices coming in at the lowest level since 2020. And still, if we look at the Fed Watch tool, the markets are pricing in additional rate holds. So why could this be? Why is the market pricing in no additional rate cuts? And why will the Fed not step away from their quantitative tightening measures so soon? Well, I believe the reason is pretty straightforward. So if we look at some recent developments in the bond market, so in the yields, we'll see that the yields, instead of going down, have went up. Now this is an important metric we can use. The yields have the tendency to front run Fed's policies. So this is an important note I want to make here. Yields always front run the Fed. We see what happened back in September when the bond market was pricing in rate cuts. So yields were going down before the Fed has cut rates for the first time. And we see actually that once the Fed has reduced their rates, yields start to go up. So why is this? Why are yields staying so strong even with the inflation rate coming in at the lowest levels we've seen it in years? Well, I think there are currently a lot of uncertainties around monetary policies and especially around tariffs. Neither the Fed nor consumers nor corporations will know what impacts will tariffs have in the next couple of weeks and how all of this will end up. Nobody really knows. There have been a lot of uncertainties around that. We've seen the market correction back in April when we had that major crash which led up to all of those recessionary fears, and eventually it bottomed out. Eventually all of those fears just disappeared as the prices went higher. But unfortunately, the fundamentals have stayed. So the uncertainties around tariffs are still there. And even though the prices have went higher in the last couple of days, the fundamentals around tariffs still remain. So in this conference, we'll go over what could this mean, what implications this may have on the monetary policies moving forward, and most importantly, how will this impact the markets, and if the risk-on thesis is still intact. I've seen a lot of questions, a lot of comments on whether the risk-on thesis is still intact. So I've covered this many times before, so I'll address this for the first time here, and then I'll make additional videos where I'll cover it once again. So moving back to the CME Fed Watch tool, the markets are currently pricing in with a 92% probability another rate hold in June. Now my current base case, and I've explained this thesis many times before, where I said that the markets do not need rate cuts in order to rally. The markets need certainty. The markets rally based on the relative confidence of investors. That's what the markets want. The markets want a stable economic environment where monetary policies can be easily predicted, and that's where the risk appetite of investors goes up. As the risk appetite of investors goes up, so does the prices. So the prices go up based on how confident investors are. When the Fed has stable monetary policies, when they keep rates at the same level for many months, and monetary policies can be easily predicted, that's where the risk appetite of investors goes up. I've made this thesis that as long as the Fed continues to hold their rates at the same level, that is what I think will lead up to the risk-on environment, not rate cuts themselves. Rate cuts at a fundamental level are not bullish for the markets. And this may sound counterintuitive. Well, how are rate cuts not bullish for the markets? How is new liquidity that enters the markets not bullish for the markets? Well, we have to think about what monetary policies really are. Monetary policies are the effect of the macroeconomic environment. So monetary policies are not the cause, and we have to think about this exactly from this perspective, that monetary policies are just the effect of the economy. So they do not drive the economy, they are driven by the macroeconomic environment and by the economy. When we have the Fed intervening in the economy, when we have changes in monetary policies, that suggests that the current path that the economy is on isn't sustainable anymore. That is what a change in monetary policies suggests. That is what it implies. So seeing changes in monetary policies is not good for the markets because it leads to uncertainty. It leads to lower risk appetite and it leads to investors becoming more cautious. Investors becoming more cautious leads to market corrections and not to rallies. So I know this may sound counterintuitive, but I think that what is truly bullish for the markets is the phase that precedes rate cuts. The phase that allows investors to speculate on the idea of rate cuts. It allows for investors to become very excited about this idea of rate cuts, about new liquidity that would enter the markets. And so this idea gets priced in. This is also how we have events getting priced in before they occur. And even though an event could be negative for the markets, we have a rally before it. Now we can go even deeper into this, onto why negative events tend to be preceded by positive events in the markets, so market rallies and so forth. And we can talk about market makers using retail as a counterparty to trade with, or we can talk about distribution ranges. So there are a lot of correlations we can make based on this concept. But the main point is, leading up to rate cuts is what is truly bullish for the markets, not rate cuts themselves, not the monetary policies changes themselves. The environment leading up into it is what is truly positive. So I think that the fact that we're seeing more rate holds and rates being held at the same level in the next couple of months. So the markets are currently pricing in September, the first rate cut. My base case a couple of weeks ago has been that we will see the first rate cuts in July. We'll have to see about that. Seeing the first rate cut in September, I think this would allow the markets to enter this risk on period to have a completed distribution phase. And that's also where I see the blow off top for risk assets developing in the next couple of months. So this has been my risk on thesis I've covered many times before. This is also something I've mentioned in many of my prior videos, and I highlighted many correlations and many confluences that will lead up to this, and we've seen it playing out exactly as I said. So we'll go over in a couple of minutes on some posts I made back in early April where I highlighted this exact thesis, and it hasn't changed since. I still believe in it, and I still believe that before we have any sort of economic downturn, any sort of bear market, any sort of recession, we will have a blow-off top in the markets, and we will have risk assets outperforming. Risk assets outperforming is what truly leads to market euphoria and to a very high degree of risk appetite, which leads to the distribution ranges. Distribution ranges which historically precede every single time market corrections. This is how we need to think about the markets moving forward, and this is how I see the monetary policies impacting the markets moving forward. Now, when we talk about yields and why didn't yields go down? So we had the lowest reading in the inflation rates since 2020, 2021. So the PPI came in really low. It came in deflationary at minus 0.5%. The CPI came in at the lowest level since 2021. Also, the core PCE came in extremely low. So why didn't yields go down? I think the reason for that, we can have two main reasons on why yields haven't gone down. The first one, which is the good reason, so we have a good reason and a bad reason. So I'm going to start off with the good one. The good reason is the economy is still resilient, and the Fed doesn't need to intervene and doesn't need to change the current path that the economy is headed. This is the good reason. This is the reason I believe to be true. This is also why I believe in my risk on thesis on why the economy is still resilient. We've seen a resilient labor market. So we'll go on a couple of macroeconomic indicators in just a couple of minutes. The main point is the economy is still resilient. The labor market is still strong. The unemployment rate is still low. And we may be heading into a midterm Goldilocks period. So for those that do not know what a Goldilocks environment is, it is the best possible environment for the markets, which marks relatively stable and high economic growth. It marks a relatively low inflation rate, and it also marks a stable and resilient labor market. And this is the best environment, the best economic environment that the markets can be in, and this leads to technological advancements, it leads to investments, and it leads to a very high degree of risk appetite, which leads to higher prices. And I think that we may be heading into a midterm environment like this. So for this reason, I think we can use yields as a very strong confluence to determine when we will see rate cuts moving forward. The fact that the yields have remained at pretty much at the same levels they have been since October of 2023. So this is almost a 2-year range we've seen. The yields are at the same levels they have been in 2 years. So nothing crazy to see here. There have been a lot of debates on the short term because of the volatility the bond market has had over the last couple of days. But if we zoom out, if we reflect on the broader market picture and on the high time frame trend, we're still in the same range we have been in. But we can make a good point from this. Why isn't the market pricing in rate cuts? The first reason is the good reason. So the Fed doesn't need to intervene. We don't need rate cuts because the economy is still resilient. The economy is still strong, so the Fed doesn't need to change the path that the economy is currently on. This is the good reason. And we have a lot of indications on, we have a lot of historical correlations on how these monetary policies have impacted the equity markets, the risk assets, and so forth. So if we look back at what happened back in 2023 and all throughout 2024, the Fed held the rates at the same level at 5.5% for over 1 year. So from July of 2023 all the way to September of 2024, this is more than 1 year, the Fed has kept the rates at 5.5%, which is the highest levels interest rates have been since early 2000s. So historical highs, levels that haven't been seen since in over 2 decades. And the market still rallied from this. Why did this happen? Well, back in 2023 and all throughout 2024, we have been essentially in this Goldilocks environment. So the inflation rate was relatively low and was controlled by the Fed as they were keeping the rates at these very high levels. We had a relatively stable and high economic growth and a very resilient labor market. So new jobs that got added to the US economy. We had a low unemployment rate, which we still do have. So this has led to a lot of confidence among investors, and it has led to a lot of economic certainty. It also led to monetary policies becoming very easy to predict, as there were no monetary policy changes for over 1 year. And this has led to this major move to the upside, to Bitcoin going from $25,000 to all the way up to $75,000. This is what this Goldilocks environment brings to the economy and to the markets as well. Now, there are endless narratives we can take from this. There are endless possibilities and endless debates we can have on the narratives that have led to the prices going up. So AI or technological advancements or the economy being in a very good spot. But I think it all comes down to the risk appetite of investors. If we think about it from this perspective, think about what the technological advancements have led to, what the stable economic environment has led to. It all leads to a higher degree of risk appetite. So investors taking more risks and investing more, seeking more gains, which leads to higher prices. So that's what has been happening. That's what we should pay attention to. And if we think about it from this perspective, from this risk appetite perspective, then I think we can gain a very deep understanding and a very objective one on what's actually happening in the markets. So fast forwarding to 2025, when we've had the opposite of a Goldilocks environment. So if this environment was marked by confidence around the economy, around monetary policies, around the Fed and economic environment, in 2025 we've seen the complete opposite, and the complete opposite of macroeconomic data. So if this was marked by a Goldilocks environment where we have a low inflation rate, we have a high economic growth and a resilient labor market, well, this environment was marked by the opposite. So negative economic growth, as we've seen the negative GDP, which came in a couple of days ago, a relatively high inflation rate or speculations of a high inflation rate moving forward around tariffs, as tariffs could lead to higher prices if they are implemented, because corporations pass costs to consumers to keep their profit margins intact. So that will lead to artificial higher prices. But that is something that we'll cover in a few minutes in detail, because I don't think that tariffs and a one-time spike in prices would durably lead to higher inflation. In order to have higher inflation, we need to have higher consumption rates. We need to have something that would durably shift inflation. So we need something that would durably shift the macroeconomic environment. And that only comes from monetary policies, or only comes from something that fundamentally shifts the macroeconomic environment. It doesn't come from tariffs. A one-time spike in prices will not lead to a durable higher inflation and to a sticky inflation. Because if we have higher prices and consumers are tapped out, then they will simply not buy that product anymore. So then tariffs actually become deflationary, as consumers just don't have anything to buy because prices are too high. So in that case, consumption rates go down and tariffs become deflationary. That's how all of this works. And a lot of people have said that we will have a sticky inflation because of tariffs. I don't think that will be the case. And we'll cover this in detail in just a couple of minutes. But now, focusing on the S&P 500, this is what led to this market correction and to this market sell-off. And it all comes down to risk appetite. It led to a lower risk appetite among investors. This is what it has led to. It has led to investors thinking on whether that was the early stage of a stagflation period, or whether that would lead to a recession, or whether that was the start of the bear market. So it all comes down to risk appetite, as I said earlier. Now, how do I believe the current monetary policies will impact the markets moving forward? And most importantly, how they will impact the correlation between risk assets and traditional equities such as the S&P 500. I believe that if we see more rate holds, so the Fed holding the rates at the same level for more months, so until September, as the CME Fed Watch tool currently prices in, then I think it gives us this very large period of time where the markets can have a completed distribution phase. Now, I've made this argument many times before. I believe that it's very likely equity markets have topped out for this cycle. I believe that the next spotlight will be on risk assets rather than the traditional equities that have rallied so much over the last couple of years. Generally, before we enter periods of before we start downtrending, before we enter a bear market, we have a very irrational period where risk assets massively outperform the traditional assets because the risk appetite is so high. So the risk appetite needs to be extremely elevated before we have any sort of economic downturn, because that is what market makers seek in order to distribute. So it all comes down to liquidity and market makers having a counterparty to trade with. We've seen the exact same concept back in 2023 and 2022 when we saw this bottoming formation. This was essentially a 1-year bottoming formation in the markets. So since 2022 all the way to March of 2023, this was a 1-year bottoming formation where fear is this is where the most fear has been. This is where the most uncertainty has been around the markets, around what's going to happen next, how low are we going to go, and is this the start of a recession? In 2023, we've also had a small liquidity crunch in the banks, And that's also what led to a lot of uncertainty around that. The Fed, the Fed has stimulated the economy a bit then to introduce liquidity in the banks. So it's a different story. But the main point is, when we have periods of accumulation, we have this volatility. This volatility is what drives the sentiment in one extreme or another. This volatility, or time-based chop, if you like it, this time-based range or capitulation is what leads to the sentiment going into one extreme or another. This is where we've seen the most fear, and I expect that moving forward, this is where we'll see the most euphoria building up. And it's likely we'll have a very similar range to the one we've seen back in 2023 and 2022. It's likely that we'll have a very similar range that will precede eventually the bear market. But in this range, in this complacency phase that will develop in equity markets, while everyone starts embracing positive narratives such as the end of quantitative tightening, the potential of a soft landing, or additional rate cuts that will come, because at this point, remember, now we're talking about July to August, so we've reached this phase. This is where people start thinking about, well, rate cuts are going to come next month in September. And that's, I think, where the most euphoria will be. That's when risk assets tend to outperform in periods of irrationality such as this one. So because of this reason, I've positioned myself accordingly. I've accumulated over the last couple of weeks, as we'll cover it, I've made public posts on my positioning, on my exact portfolio management, which we'll go over. But the main point is, this is what we have to focus on, not on the short-term noise. Alright, so it all started from yields. Yields being in this range. And if you guys remember, a couple of minutes ago I said we had two reasons. The first one was the good one, which we just covered. We just went through. The good reason leads to this risk on period. This is my current base case. Because we have a very resilient labor market, as I explained earlier, we have a strong labor market, low unemployment rate, and even though the GDP came in negative for the first quarter of 2025, which actually refers to the fourth quarter of 2024, it came in negative. It came in because of pre-tariffs imports. So there was a massive spike in imports as corporations tried to front run tariffs, try to buy raw materials and whatever they need before tariffs hit. So they buy it for cheaper prices. A spike in imports leads to a lower GDP. This is why I think we've seen a lower GDP. You can do the research. A couple of weeks ago, it marked the highest imports ever. It marked the highest trade deficits ever. So you can do the research. Imports lead to a lower GDP. This is why I think we've seen a moderate contraction in the economy instead of a moderate growth. So the economy is still resilient. This is the good case. The Fed doesn't need to intervene. But then there's also the bad case. So what is the bad case? Well, the bad case is pretty straightforward. If you look at what happened back in 2006, 2007, we've had yields going down initially as rate cuts were getting priced in and so forth. But then we had a sweep of these highs. So there were these highs that developed, and then later on we had this sweep. Now the sweep is actually very interesting. So as I mentioned earlier, yields have the tendency to front run Fed's actions. But what's really interesting is that the yields weren't pricing in rate hikes. The yields were going up because investors were losing confidence in bonds. And this is what's truly interesting. When yields go up, it signals that somebody's selling bonds. So there is this inverse correlation between the price action and the yields of a bond. When the yields go up, the prices go down. When the yields go down, the prices go up. So we have this very interesting correlation that we want to focus on. When the yields were going up, the bond market wasn't front running the Fed. So the bond market wasn't pricing in rate hikes by any means. What the markets were telling us was that bonds were becoming riskier. Being invested in bonds, being invested in the credit market was becoming very risky. So for this reason, a lot of people got out of bonds right around 2007. I think this is where main players got out. This is where the smart money got out. This is why we've seen this major spike in yields before eventually we had this major capitulation event and the great financial crisis. All of this was preceded by a spike in yields. Now this is interesting. This is where it actually gets interesting, because today, so actually yesterday, we've had Modi for the first time downgrading the US from AAA to AA1. And Modi has did this for the first time in history, has downgraded the US. And this is very interesting. Their explanation was that because of the lowering in credit reliability and because of ballooning debt of the US, they came to the conclusion that the path that the economy is headed on the long run, which is the inflationary one, which is the one that the Fed and the governments take on more and more debt, isn't sustainable. Who would have guessed? Who would have guessed? You can say that it is political. You can say that the timing is off. You can say a lot of things about this. But the main point is this. The confidence in the bond market is going down. The confidence in the credit market is going down. For this reason, we can also have yields staying so high, yields actually going up, and yields potentially sweeping the prior high, this one. And this is where it would get interesting, because looking back at 2006, this is pretty much where the highs got swept then as well. So these were the highs, these are the current highs. If we do see a sweep, I think this would be a clear indication that the bad reason could be in play. And now we're not looking anymore at the good reason, where the economy is still resilient and the markets are simply not pricing in rate cuts because the Fed doesn't need to intervene through stimulus and through rate cuts and so forth. We're not looking at that anymore. Instead, what we would be looking at will be smart money exiting the bond market. And so I've seen a lot of questions, a lot of comments around the latest downgrade of Moody, of the US. These are pretty much my thoughts. The timing seems to be a little off, but the fundamentals are definitely there. The only question I have is, why didn't we see this downgrade sooner? So this has been going on for years and years and years. Historically, the Fed has always chosen the easy way out, which is the inflationary way, which is the way that they print money, they take on more debt, and they just print their way out. That has been the easy way. This is the easy path that historically the Fed has always chosen, because by doing this, the government doesn't lose the political support. So think about choosing the hard way, the recessionary way, the way where you tell people that they will lose their jobs for the good of the broader economy. Think about explaining that to your supporters. It doesn't work that way. So there are different considerations, not just the economy, that the Fed and the government need to think about by adopting the hard way, which would be the healthy way for the economy, where they say, okay, we're not going to print our way out this time, but instead what we're going to do is let the economy fall into a brief recession before we eventually have fundamentals taking over once again, people realizing that it is not as bad as it seems. At that point, a lot of jobs have been lost, but it's all cyclical and it will get back to being good once again. So that is where they induce an artificial recession, essentially, and they break the cycles, they break the business cycles, and I think that would be a lot healthier on the longer run. But what they do is they print their way out, they choose the easy way where they do not lose the political support, because as I explained earlier, it would be very tough for households to understand that it is better this way, the recessionary way, where they lose their jobs, they lose their homes. So yeah, it would be bad. So they choose the easy way, they print their way out. So coming back to what I was saying earlier, this would be the bad reason that we could be looking at. The sweep in yields could be the bad reason that could precede the next economic downturn. If this case plays out, and once again, we need many more conferences to confirm that this case is indeed playing out. But if this was the case, then I think that things will not look great for the markets in the midterm, and neither on the high time frames, because, as I explained earlier, in the good case, we would have this complacency phase, which would lead up to a blow off top in risk assets and eventually a bear market. But I think that if we have the bad reason playing out, we could have a very short complacency phase developing, so only for a couple of weeks before the markets eventually start pricing in this economic downturn. Before any changes in monetary policies are ever made, before we have any sort of actual confirmation, the markets will start to be foreseeing to these events, and we will have a market downturn before we have the economic downturn. So this is how I think the markets would look like if the bad reason were to play out, though I don't think it will. So once again, we can only speculate on this idea. We can only speculate that we could have the sweep in yields that would eventually precede this downturn as the Fed then intervenes. So it will be interesting to see how all of this plays out. But these are pretty much my thoughts on the latest downgrading of Moody, of the US, and the bond market, the yields staying elevated despite the lowest inflation reading we've seen since 2020 and 2021. We have two reasons on why that could happen. The good one is that the economy is still resilient and that the Fed doesn't need to intervene, and that the path that the economy is on right now is still sustainable, at least on a midterm basis. And the bad reason being that investors are losing confidence in the credit market, therefore they are exiting bonds, and that leads to higher yields. So these are my thoughts on that. Now I want us to have a look at one of the posts I made back in early April. This is made on April 5th. Bitcoin was around $80,000. The S&P was around $5,000. here I said at that point there was a lot of chatter around the decoupling. So you see here, Bitcoin was holding pretty strong while the equity markets were going down. I said that the real decoupling will not occur on a short-term basis. The real decoupling, and this is something that a lot of people have highlighted at the time, if you'll remember how Bitcoin was holding so strong against the S&P, the Bitcoin is finally decoupling from the equity markets and so forth. A lot of people were saying that. Eventually we had a sweep of the lows here. We had Bitcoin going to $74,000. This is also what I highlighted here through this line. I said that in the short term, I don't think it changes much. A sweep below $76.6 thousand, which at the time were the lows, is still on the table. But on the midterm, that divergence was a clue on where liquidity will flow next. And this is really interesting. This is where it gets really interesting because, as I said here, I think this risk on environment thesis is still in play. Despite the chatter around yield, despite the debates on Moody's downgrade and a lot of other things, despite everything else, we have to reflect on the real and objective fundamentals that have an impact on the economy and on the markets. So far, nothing has changed. From a fundamental level, the fundamentals are still looking great. The labor market is still resilient. We still have a relatively high economic growth. And for that reason, I believe it is likely that this risk-on thesis is still in play. So moving forward, we've seen the equity markets bouncing as we see here. So we've seen this bounce already. Now I expect equity markets to enter this complacency phase where they will enter this distribution phase while liquidity starts to flow into risk assets. So I've highlighted this many weeks ago, back in early April. Remember how people felt when we were at these levels. This was the most contrarian view you've seen. This is the most contrarian to how everyone felt. Everyone was highlighting that a recession was next, a bear market was next, everything has entered the bear market, and everyone was saying the exact same things. I said, and we'll go on in the upcoming post, I said publicly I had the lowest cash positions since the 2022 bear market lows. I publicly said that. I publicly acknowledged my bullishness. Nobody did that, or at least not many people did that. Most people were incredibly bearish. Most people were trying to gather up liquidity to position themselves for lower prices. This is where I accumulated. And this is where I said that we will see this risk on environment. This was the contrarian view to how most felt. And for this reason, this is why I think it is still in play. Because it is still contrarian to how most people are feeling right now. I expect we'll have higher prices in Bitcoin in the coming months. And we've seen the reversal. We've seen how Bitcoin has performed over the last couple of days. It has reached levels close to the prior all-time high. And I expect, and I don't think the train is stopping here. I think this is just the beginning of the end, let's say. So in the coming months, let's not forget what all of this would lead up to. Let's not forget what this risk on environment would lead up to. It will lead to a bear market. It will lead to lower prices. It will lead to an economic downturn. But we can make a lot of money from it. And we can make a lot of money if we pay attention and if we stay sharp. We can make a lot of money on this rally. I've made a lot of money from this rally since I bought in early April. And I've secured some of those profits I've made, which we'll cover in a couple of minutes. This is how I see the decoupling between Bitcoin and the S&P 500. I don't think it has a major impact on the short term, though I think it is a clear indication on where liquidity is headed next. And I've made this argument around the end of quantitative tightening, around this complacency phase. In complacency phases, we have a very strong narrative that everyone embraces, which leads to a very high degree of risk appetite. That risk appetite, that very high sentiment of euphoria and excitement and greed, is what actually leads to these distribution phases. And this is what allows market makers to distribute and to sell. Once again, because it precedes a larger economic downturn. This is how I see the decoupling between Bitcoin and the S&P 500 moving forward. Now, looking at a post I made here. So, I actually highlighted here. When we talk about this, when we talk about moments where the markets are going down, when we talk about crashes in the markets, that's where we have to step back. That's where we have to reflect on the broader market picture and ask ourselves, has something changed? The prices are lower. The prices are going down. In periods like that, like we've seen back in early April, the sentiment tends to go in extreme fear. That's where a lot of people capitulate. That's also where you can find the greatest buying opportunities. So that's where you have to step back and reflect, and ask yourself, has something fundamentally changed? I asked myself that question, and the answer was no. Nothing has fundamentally changed, not then and not now. The fundamentals are still the same. The economy is still resilient. The labor market is still strong. The unemployment rate is still low. So I analyzed all of those confluences and I said publicly that I had the lowest cash positions since 2022 bear market lows. This post was made exactly on April 4th when the S&P has reached its bottom. When Bitcoin was around $76,000. That's where I said I had the lowest cash positions because the fear is what exactly market makers want to see before the trend reverses. And I've made a lot of theses around this. I made a lot of correlations between on-chain data, between market structure, between price action, between narratives, between headlines, between everything. If you remember the thesis I've covered all throughout February and all throughout March around the liquidation cascade that developed on the low time frames and how market makers use that. So if you go to a chart, let me show you right here what I'm talking about. If you look at this, on this chart, you'll see exactly what I'm talking about. All throughout January, all throughout February, all throughout March, and all throughout April, we've had one similar thing. We've had one confluence that has played out over and over and over again. That is a series of untapped lows that developed on the lower time frames. So this series of untapped lows, and I've explained this many times before, how this series of untapped lows develop, what they lead to, because they lead to a whole lot of stop losses, a pile of long positions sitting there, a pile of untapped liquidity sitting there that waits to be swept. So then we have all of these stop losses that sit there. Traders set their stop loss. If they want to enter a long position, they would set their stop loss at the nearest low. So if they do that, if we have the same incident happening over and over again, then we have these untapped lows that develop. This liquidity never gets swept. So there are more and more piles of longs sitting there. There are more and more stop losses sitting at these levels, which are stacked up on top of each other, and then we had a tariff announcement, which led to a liquidation cascade, which triggered all of those stop losses. If we think about what a stop loss of a long position means, it is a forced sell order. What did market makers want to do throughout the past months? This has been my thesis. This has been my argument on why we will see higher prices and how market makers have used the past few weeks to accumulate and to use counterparty and to use retail as a counterparty. This has been my argument. The series of untapped lows that developed over and over again. So we see it happening over and over again. And guess what? Guess what led to all of these liquidation cascades? Trump and a tariff announcement. This is why I think we've seen so much uncertainty around tariffs. Somebody wanted to accumulate. Somebody big wanted to buy. Someone big knew what would follow next and what would follow in the next couple of months. This is also what gave me a lot of confidence to accumulate and to see that the bear market has not started yet and that we are headed higher in the coming weeks. By identifying this series of untapped lows that develop each time on the low time frames, we see it playing out over and over and over again. Take these lows, it has led to this liquidation cascade. Take the lows in early March, guess what it led to? This liquidation cascade. Take the lows in late March, that led to this liquidation cascade in early April. So there was this series of untapped lows that played out every single time, that led to a liquidation cascade that helped market makers accumulate and find an artificial counterparty. And I said at that time, that is how market makers accumulate. They want to position themselves for something much bigger. And I've explained how all of this will eventually lead up essentially to an emotional gap. An emotional gap is a very rapid transition from a state of fear and anxiety to a state of full-blown euphoria. How this develops is very interesting, and we've seen it playing out exactly as I predicted in September. So take this for back in September, this is where I first highlighted, this is where I first explained this thesis around an emotional gap and how it develops. So let's take it as an example here. And it is all public. You can find the posts I made. It is all public knowledge. You can find it on my X account. How this develops is we have this range low bottoming formation on the high time frames where there is a lot of fear, there is a lot of uncertainty, and market makers accumulate. And we've seen this exactly playing out in early August, when everyone was screaming for a recession, when everyone was embracing the yen carry trade crash narrative. Everyone said that somehow a couple of hedge funds that have blown up because they were over leveraged through carry trades, so they were essentially borrowing yen at negative interest rates or at very low interest rates to purchase US equities, because at the time the BOJ, the Bank of Japan, has raised rates. It has destroyed this whole model. So now all of these hedge funds needed to take out money in this in this low liquidity environment. So there were no buying. There was no buying pressure. So because of this, because of everyone needing to sell, it led to this very fast sell-off in the markets. This is what led to this crash in early August. For those that do not know, now you do. Then we had September. September, I think, was even worse than early August. September was the capitulation phase, was where everyone capitulated and everyone gave up. Everyone started to believe that no, this was actually a corrective move, and then we're headed lower to $44,000. Those who were here remember what I was saying. if we would have reached $44,000, the bull market was over. It would mark a very great, a big deviation. It would mark a structural break. It would mark all of these things that wouldn't be bullish for the markets. A lot of people start to believe in this idea. As always, I'm contrarian to how most feel. So I said, no, the lows are in. I'm buying. I'm longing this. I don't care. And I was right. But let me tell you how this emotional gap develops. So after we've seen this capitulation phase, after we've seen this extreme fear and extreme anxiety, everyone capitulating, and everyone, most importantly, and remember this, everyone increasing their cash exposure, everyone wanting to get liquidity at these levels because they are scared. How this works is very interesting. After this capitulation, we have these bounces. This was the final correction. This was the final actual pullback, true pullback. This was it. This was the opportunity. Here a lot of people said, no, we're going lower. I'm waiting for lower prices. Notice something. Notice the disbelief sentiment. After we bounce from this extreme fear and capitulation phase, and people have increased their cash exposure, then we have these dips. No, I'm not buying. I'm waiting for lower prices. I'm not certain. I need more confirmations. This is how retail investors feel when we see these bounces. This disbelief eventually leads up to these major rallies. Here, there were no pullbacks anymore. People were still waiting for lower. There were no pullbacks. There were only these consolidation phases that eventually led up to these major parabolic run-ups. Now, remember, the average retail investor has increased their cash position here. Then we had the disbelief phase where they didn't buy. And then we have the emotional gap finally being formed. Then we have the rapid transition from that state of extreme fear to the state of disbelief to full-blown euphoria and everyone trying to buy. When we eventually reach these levels, here, everyone wants to buy, everyone FOMOs in. This is the basic definition of FOMO, fear of missing out. This is where people want to buy because they say, okay, I was wrong, but now is the time to buy. Now is the time to get exposure to Bitcoin because we are headed much higher. We have Trump being elected as president. We have a Bitcoin US strategic reserve being implemented. So normally it should lead up to higher prices, right? Well, the thing with emotional gaps is that it leads to emotions. So it leads to retail investors becoming subjective and emotional rather than objective and level-headed. This is what emotional gaps lead to. So after that state of extreme fear and anxiety, disbelief, the emotional gap is formed. Now we're in a state of full-blown euphoria where investors seek confirmation biases through narratives. That's where market makers want to lead the sentiment. That is where market makers want to have retail investors at their pinky finger. Because they all need liquidity. So it all comes down to liquidity. It all comes down to having a counterparty to trade with. Here, they had a counterparty because everyone was scared and everyone increased their cash positions. Then, nobody wanted to buy. Or there were a lot of people who've shorted along this rally because they didn't believe. Or they wanted more confirmations that was the true breakout. And we'll get on that in just a couple of minutes. But then, they also have a counterparty at the top to distribute. Because now people are feeling extremely euphoric. The retail is finally back. We've seen a lot of confirmations of that back in December and back in January when everyone was embracing the same narrative around Trump. around the US Strategic Reserve. The Google searches for Bitcoin and the Google trends for Bitcoin were also confirming that. There were a lot of searches for how to long crypto or how to buy Bitcoin and so forth. The sentiment on X was in extreme bullishness. Everyone was saying that we are headed a lot higher. This is where I also made a post that I made a public post that I de-risked the majority of my portfolio. At this time, this is where I expected the cycle top to be actually in, because of some posts and some predictions I made back in September where I said that it's likely we'll have one final leg up to the $100,000 to $110,000 range before we eventually top out and start the bear market. So I thought, well, we have all of these confluences, so normally I was right. We are headed into a bear market next. So I can say that I was lucky because I thought that, because I personally didn't expect for new highs in the coming months. Here, I personally thought, okay, now a bear market is next. But once I saw how fast the sentiment has shifted from that extreme euphoria and extreme bullishness to fear once again, and everyone capitulating once again, and all of these liquidity traps that helped market makers to accumulate, I flipped my thesis. And one of the confluences that gave me confidence was actually the Bitcoin dominance. I used the Bitcoin dominance as a measure of the cycle. I assess the broader cycle by using the Bitcoin dominance. The Bitcoin dominance tells a very interesting story about risk appetite. When the Bitcoin dominance is going higher, it is the same correlation between equity markets and Bitcoin. Think about how I said equity markets will enter a complacency phase that will lead up to a blow-off top in risk assets. So Bitcoin and small caps. Think about that for a second. When we have liquidity flowing into the traditional assets, it marks that the bull market is still intact. The normal distribution is still intact. So we have the Bitcoin dominance rising, signaling that there is no distribution towards altcoins. And this is a concept that a lot of people have failed to understand, unfortunately, when all throughout 2023 and all throughout 2024, they have called for an alt season. Let me tell you this. Calling for an alt season is the same as calling for a cycle top. Calling for an alt season is the same as calling for a cycle top. So, as the saying goes, be careful what you wish for, because an alt season marks the final distribution from Bitcoin towards altcoins. It marks the final rotation out of the traditional assets that have already pumped to the risk assets, as there is a very high degree of risk appetite as everyone seeks gains and risk and profits. That is what an alt season implies. And that is what a crash in the Bitcoin dominance would imply. So I've used the Bitcoin dominance as a way to assess where we're currently in this cycle, and as a way to assess how healthy the current cycle is. When I saw this dump in the Bitcoin dominance back in December, I said, okay, that's it. Now it's likely that we'll have this alt season. The Bitcoin dominance has also topped out here. Bitcoin has also topped out here. We're entering this distribution phase. Altcoins are poised to outperform. And that was pretty much the end of the story. That is where I increased my cash exposure a lot. And that is also where I publicly mentioned that I was expecting a bear market. But then once I saw the Bitcoin dominance going higher, and me being wrong on my thesis around an alt season and the cycle top to be in, because as I said earlier, if you're wrong about calling for an alt season, you're definitely wrong on calling for a cycle top. So the Bitcoin dominance and the Bitcoin dominance going higher is what gave me the confidence to accumulate. And also there were a lot more confluences to this, such as the on-chain data, the sentiment, the market structure, the liquidity traps, the headlines, and the Bitcoin dominance. So this is how I've used the Bitcoin dominance as a way to assess the broader cycle, and I'm still using it. This is where my main focus is right now, on the Bitcoin dominance. I'll soon share a detailed video on the perspectives I have currently on the Bitcoin dominance, so make sure you stay tuned for that as well. It will go up on my YouTube channel, the same channel this recording will also go to, so make sure you stay tuned for that. I post very frequently, almost on a daily basis. So a lot of there are detailed videos, detailed insights that I can share on my X account. So if you like what I do, if you want to support me, please make sure to follow me on my YouTube channel as well. I share quality content and I try to bring out the best value for you guys. So that's the thing with the YouTube channel. So now I want us to have a look at the low time frames. We've gone through a lot today. We've gone through yields, we've gone through the macroeconomic environment, we've gone through monetary policies, we've gone through the broader cycle and how we can assess it and the confluences that we can track. So we've gone through a lot. And I know a lot of you are interested in my perspectives on the low time frames. So here they are. On the low time frames, I'm currently tracking two potential scenarios that could take place in the next couple of days. The first scenario is the bullish scenario, which implies that we will have this consolidation right beneath this high time frame resistance range before we eventually have a breakout. This is the bullish scenario. Then there is the dip scenario, which implies a deeper correction that will later on lead to this impulse up. Now, I've explained a lot of confluences to this, a lot of confluences that will lead up to each scenario. So if you haven't, make sure to check it out here. It's a post I shared a couple of days ago. Now, moving to the charts, I will explain it to all of you live because we're not here to look on some old posts I made. You can do that on your own. I'm here to explain it to all of you live. The point is, and this is where the emotional gap comes into play. This is where it all comes down to. This is how everything correlates with this thesis and this blow off top and risk on period. After we've had the extreme fear all throughout March and all throughout early April, now it seems like we're in the same disbelief period to the one we've seen back in November. If you guys remember, this was the disbelief period. The disbelief period has the tendency that it doesn't allow retail investors to enter. So instead of seeing pullbacks that would allow retail investors to enter lower, so here they would buy, then the price pumps. Instead, this doesn't happen. This market doesn't give the opportunity for sideliners to enter lower and to invest their capital, because later on market makers want liquidity to distribute at the top. So this is where it gets interesting, because we've had these consolidation phases, and this was a clear impulse corrective move. So we've had this impulse up, consolidation period, impulse up, consolidation period, impulse up. Instead of seeing corrective moves, we've had these consolidation periods. Now the thing with these consolidation periods, as reflected in the Velo data, which is also something I track frequently, is that in these consolidation periods, people flipped bearish. People start to call for a corrective move, which only fueled this rally. And I've made a post on this when we were around 90, when we were in the mid 90s. So in this consolidation phase, I made an argument that the local bottoms in funding rates have coincided with local tops in price. So I made this argument. This was very, very interesting to me, because the way I interpreted it was that shorts were getting protected on the short term, making bears feel comfortable shorting, leading up into a bigger short squeeze ahead. So each time we've tested these highs, there was some spot sell pressure that made the prices go lower, so shorts were protected on the short term. Now this is exactly what we've seen back in 2024, when throughout that whole accumulation range, the highs never got swept until we had that major breakout. So if we look at this, the highs never got tested. The highs never got tested until we had this major breakout. So there was the same concept, just applied at a smaller scale, of the highs never getting tested, and essentially each time the shorts are in danger, somebody intervenes and the prices go lower on the short term, and we had these shorts protected. And it essentially gave the bears an opportunity to exit their short positions. Now I said here that as the local bottoms have in funding rates have coincided with local tops in price, it could lead up to a bigger short squeeze ahead. And it looks like I was also right on that, because we eventually had this breakout from $93,000 all the way up to $106,000 in a matter of days. And we see here exactly what I was talking about. As the price has went higher, as you guys can see here, the open interest has went lower as shorts got squeezed, shorts got flushed, and for that reason, the open interest, which measures the total perpetual positions, has gone down. So with that being said, let's now return to what I was saying here. The disbelief period. The period where there is the transition from the state of extreme fear. This is the transition phase, the disbelief phase, which eventually leads up to a bigger expansion ahead. So this is how I'm currently interpreting the charts. And from an Elliott wave standpoint, I made a post a couple of more days ago around this being a corrective wave 2 that would eventually precede this major impulsive wave 3. And do not take into account neither the time nor the price. This is just to represent the next move. So I'm not saying that we'll reach $150,000 in June, but what I'm saying is that I believe this phase precedes a major rally ahead. And I believe that this is the disbelief phase, and the transition from extreme fear to later on full-blown euphoria once we'll enter the distribution phase. Once again, this has the feature that it doesn't allow sideliners to enter because market makers need liquidity at the top. When we'll enter this distribution phase and market makers need to sell, that's where they need liquidity. So they had a counterparty to accumulate, as we've seen extreme fear, extreme capitulation, everyone increasing their cash positions back in early April and started to call for a bear market. Remember, that's also where I said that I had the lowest cash positions since 2022. This is where you want to buy. And later on, market makers will have the counterparty to distribute and to sell what they've accumulated a couple of weeks ago. So that being said, this is how I'm currently interpreting everything from the macroeconomic environment to the monetary policies to the broader cycles to the low timeframes on Bitcoin and the S&P 500. So this pretty much wraps up our conference for today. If you've enjoyed it and if you've watched so far, thank you for joining today's conference, for the ones that have joined in live. And if you've watched the recording, thank you so much for watching it. I hope it has been helpful and valuable, and I hope you have learned something new today. So with that being said, this wraps up our conference for today. Thank you all for joining, and I wish you all an amazing weekend ahead.